Can AI really beat the stock market? It's a question worth billions. Think of trading like playing poker in a dark room. You're making bets with incomplete information, trying to spot patterns others miss, and hoping to maintain a small but consistent edge. Basically, edge means an advantage that helps you win more often than you lose. Now, the real question isn't whether AI is smart enough. It's whether it can actually turn that intelligence into profits. Let's see where AI actually helps. AI excels at several specific things in trading. First of all, pattern discovery in large datasets. For example, Renaissance Technologies, one of the most successful quantitative hedge funds, uses machine learning to scan tick data across 5,000 stocks. Here, tick data means individual price changes that happen every few seconds. It will find micro-patterns that predict the next 10-second price move. Next, processing unstructured data. JPMorgan, a major investment bank, employs natural language processing models to read thousands of earnings transcripts and detect shifts in management tone. Basically, how confident, cautious, or optimistic executives sound when discussing their company's performance. And they use computer vision to analyze satellite imagery, such as parking lot traffic or shipping containers, to predict quarterly results before official announcements. Third, smart order execution using reinforcement learning. When you want to buy or sell a large amount of stock, you can't just dump the whole order into the market at once. That would push prices up or down against you before you finish. Here's where reinforcement learning comes in. The AI agent treats each trading decision as an action: how much to trade, when, and where. It gets rewarded when it minimizes market impact and gets a lower price, and penalized when it moves the market against you at a higher price. Through millions of simulated trades, the system learns the optimal strategy to break your order into smaller pieces and send them to different trading venues at different times, getting you a better deal overall. Fourth, combining weak signals into stronger predictions. Imagine having dozens of small clues about where a stock might go. Each one alone isn't very reliable, but techniques like random forest can weave them all together to form a much more accurate forecast. It's like assembling a puzzle. One piece doesn't show you much, but put them together and the picture becomes clear. In summary, AI excels at processing and analyzing large amounts of data, especially unstructured data, and then helps you make smart decisions. However, there are fundamental limitations to what AI can achieve in trading. For instance, AI cannot truly predict the future. Take the case of long-term capital management, a large hedge fund that employed sophisticated mathematical models. Their models relied on the idea that historical relationships between different investments, called correlations, would continue as they always had. But then, in 1998, when Russia failed to make payments on its government loans, effectively defaulting on its debt, all those expected correlations suddenly broke down in unexpected ways, causing massive losses as the models failed to account for these new market dynamics. This incident highlighted a crucial point. Financial patterns, while appearing as statistical regularities, are not like physics. They can change abruptly and unexpectedly. Moving on, another critical limitation is that AI also can't fix bad data. If you accidentally use information from the future to build your prediction models, something known as look-ahead bias, you'll get amazing but ultimately useless results in testing, leading to catastrophic failures in real trading. Furthermore, AI cannot eliminate risk. The 2010 flash crash is a prime example of this. Within minutes on May 6th, the stock market plunged by nearly 1,000 points, only to recover most of those losses just as quickly. This extreme volatility was partly amplified by high-frequency trading algorithms interacting in unpredictable ways. In summary, complex AI, especially black box deep learning models, might find superficial connections in data that disappear under pressure, leading to more intricate and unpredictable failures rather than safer trading strategies. Actually, AI isn't a standalone trading system. It's a modeling approach embedded within broader systematic workflows. These workflows can be rule-based or model-driven, but all of them rely on automation, repeatability, and disciplined execution. Even with these systems in place, you still need human oversight, risk limits, and governance. So, when does AI help compared to more traditional systematic approaches? Factor models, for instance, are rule-based quantitative strategies that have been used for decades. Factor models are simpler approaches that look at some specific company characteristics, like financial health or trends, to predict returns. The key advantage? They tend to perform consistently, even on new data they haven't seen before, which we call out-of-sample testing. They're transparent and easy to understand. Machine learning, on the other hand, shines when relationships are complicated and messy, when patterns change over time, when you're analyzing unusual data sources like satellite photos or social media posts, or when you need to combine hundreds of tiny signals into one decision. But here's the catch. All that extra sophistication only pays off if the gains you make are bigger than your trading fees, and if you don't end up chasing patterns that were just random noise. So, how do you know if your AI model actually works? Here's the tricky part. You can't just look at profit. A model might make 15% per year, but swing wildly up 30% one month, down 25% the next. Another model also makes 15% but climbs steadily with tiny dips. Which would you trust? This is why traders look at the Sharpe ratio, basically how much return you get for the risk you're taking. More steady, less roller coaster? Better. But even that's not enough. You also need to check the maximum drawdown, the biggest loss from peak to bottom. Think of it like this. Your account hits $100,000, then crashes to $50,000 before recovering. That 50% drawdown? Most people would panic and pull out long before the recovery. There's also win rate versus payout. You can be right most of the time, but still lose money if your wins are small and your losses are big. AI can catch lots of tiny movements, but miss the major reversals. Then there's transaction costs. Every trade costs money and fees, and frequent AI trading can eat up profits fast. The biggest danger, though? Overfitting. This is when your AI memorizes the past so well that it becomes useless for the future. It's like studying only last year's exam questions. You'll ace the old test, but fail the new one. Backtests look perfect. Real trading? Not so much. So how do you avoid falling into the overfitting trap? The key is strict testing on data your AI has never seen before, called out-of-sample testing. Here's how professionals do it. You train your model on several years of historical data, say 2018 through 2022, then test it on completely separate years like 2023 and 2024. After that, you run it in paper trading mode in 2025, where you simulate trades without risking real money. Only then, if it still works, do you deploy it with a tiny amount of actual capital. The idea is to keep validating forward through time, constantly checking if the model still performs. There's another pitfall to watch out for. If you create 100 different AI variations and only report the one with the best backtest results, you're not actually finding a good strategy. You're just cherry-picking random luck. And even when AI finds a profitable pattern, it doesn't last forever. Why? Two main reasons. First, competition. When one fund discovers that certain words in news articles predict stock movements, other funds eventually notice the same thing and start trading on it too. Once everyone's doing it, the advantage disappears. Second, markets change. The patterns AI learns can simply stop working when conditions shift. A model trained during calm markets might completely break during a crisis when everything suddenly moves together. This means you can't just build an AI trading system once and forget about it. You need to constantly monitor whether your patterns still work and retrain your models as the market evolves. Finally, let's answer the initial question. Can AI help trade stocks? Yes, but it's a tool, not magic. AI excels at finding patterns in massive datasets and adapting execution strategies, but it can't predict the future or eliminate risk. The challenges are real. Overfitting, high costs, decaying edges, and evaluation beyond simple returns. You need rigorous validation, continuous monitoring, and discipline. Thanks for watching.